Y'all ready for this? Let's go.
Welcome back to the Ben James Smith podcast. Today I want to talk about something that sits at the centre of property development, but is very rarely discussed properly. Capital structure, not how much capital is used, but how it's structured. Because in property, many projects don't fail because they are bad projects. They fail because the capital behind them is misaligned. And once you understand that, you start to see the same pattern repeated again and again across the market. In property, there's a lot of focus on identifying a good deal. Location, planning, build cost, GDV, and all of those things matter, but they don't determine the outcome on their own, because even a strong project can fail if the structure of capital behind it forces the wrong decisions at the wrong time. So the real question isn't, is this a good deal? It's, is this a structure that allows the deal to succeed? Most traditional development funding follows a familiar model: senior debt from a lender, equity from investors, delivery by the developer. On paper it works, but the incentives are not always aligned. Lenders prioritize capital protection, developers prioritize project completion, equity prioritizes return. Those priorities only align when everything goes to plan. So, what happens? When conditions change, markets don't move in straight lines. Timelines shift, costs change, sales slow, and when that happens, incentives begin to diverge. Lenders may want repayment or enforcement. Developers may need more time. Equity may want to preserve value. At that point, the structure becomes more important than the asset, because the party with control determines the outcome, not necessarily the party best positioned to create value. In development, time is everything. Time to complete, time to sell, time to refinance. And misaligned capital structures remove control over time. If capital is tied to fixed deadlines, if extensions are uncertain, if refinancing is required at specific points, then decisions become forced, and forced decisions destroy value, not because the project is bad, but because the structure doesn't allow flexibility. So why do good projects still fail? This is the part most people don't see. A project can be well located, properly designed, financially viable, and still fail because it runs out of time, or because control shifts at the wrong moment, or because the structure prioritizes recovery over completion, and when that happens, value is lost, not created. So what's the real lesson? The lesson isn't about avoiding risk. It's about understanding where risk actually sits. And in many cases, risk doesn't sit in the property, it sits in the capital structure, in the alignment of incentives, in the control of time, in the ability to adapt when conditions change. That's what determines whether a project reaches its potential or is forced into an outcome that doesn't reflect its true value as a result of third-party lenders. To achieve alignment, we shift in thinking. Once you understand this, your focus changes from finding good deals to building better structures, from maximizing leverage to maintaining control, from reacting to capital to structuring capital. And that shift is what separates transactional development from scalable investment fund platforms. So when evaluating property opportunities, it's worth looking beyond the surface, beyond the numbers, beyond the plans, and asking a deeper question: does the capital structure support the outcome, or is it weighted towards a third-party lender? Because in property, the difference between success and failure is often not the asset, it's the capital behind it. Thanks for listening, and remember, in development, the project creates the opportunity, but the capital structure determines whether that opportunity is realised. I'll see you in the next episode.